Good morning, everyone, and welcome to the investment meeting for February 2015. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, designee for Police Commissioner Bratton.
Barry Dennis, consultant to the fund.
Joe Alejandro, designee for Patrick Lynch, Mubarak Abdul-Jabbar, John Puglisi, and I also have the proxy for Albert Asiano.
Chris McGrath, PBA by invitation.
Bob Ganley, SBA, designee for Ed Mullins.
Lou Charco, LBA.
Demetrius Roumeliotis, CEA designee for Roy Richter.
Michael Palladino, DEA.
John Mercerberg, Controller's Office by invitation.
John Dorser, Controller's Office, alternate designee.
I'm just here so I don't get fined. Martin Gans, Controller's Office by invitation.
Susanna Vickers, designee for Controller Scott Stringer.
Antonio Rodriguez, designee for Finance Commissioner Jackie Hugo.
Carolyn Wilford, designee for Mayor de Blasio.
Bob Sansky, State Pension Fund by invitation.
Kevin Holleran, Pension Fund by invitation.
Tom?
Tom Brady.
Tom Brady.
Justin Holt, State
Okay.
Nicole Jambrisi, Police Pension Fund by invitation.
All right, with that, Martin?
Yes, thank you. So everyone should have a copy of color pages in front of them. Books, if you don't, we have plenty of extra copies. Most of the first section of the book of the Bloomberg charts show, as you know, the economy expanding. So for instance, page 5 show unemployment that the government produces, the Labor Department down to 5.6% in the latest print. Consumer confidence on the next page, on page 6, at a new multi-year high, although when you compare it to before the crisis it was higher. Home sales are strong on page 8 and page 9. Retail sales are good. Auto sales are near all-time highs. Well, nearly 17 million on an annualized run. Index of leading economic indicators on page 12 continue up. And inflation is well under control, less than 1%. That's actually a concern because the Fed wants a certain level of inflation because we are importing potentially deflation from the other parts of the world, developed markets, EFA, as well as emerging markets that are slowing down. And much of what goes in there and the reason the inflation is so low, I guess you're wondering why it's 0.8, is a big input is energy. And we have a new chart that we'll go through later that we put in here for the price of oil. And the price of oil has gone down 50% in a very short period of time, and it's a big input that goes into the CPI calculation. Turning to page 15 and 16, we show how the U.S. dollar looks versus other large currencies. So page 15 is the dollar versus the U.S. dollar index versus other large currencies, and it's at a multi-year high. I believe it goes back 89 years. And part of that is because of page 16. It's at a high, while it shows it low, it's because it's the euro versus the dollar versus the euro, say the euro versus the dollar. It's at 112, so it takes $1.12 for 1 euro. We're headed towards parity. So this is now more than a 9-year high for the dollar versus the euro. We don't show the Japanese yen, but the Japanese yen is a over a decade high for the dollar against the Japan. So when you take all these large currencies into account, the dollar is strengthening. This hurts in the U.S. exporters because our goods are more expensive in the currencies that are depreciating, but it also imports deflation, so things are cheaper for us to purchase when we're purchasing goods that are imported. Pardon me. Turn to, this is the new chart I was referring to, page 17, because it's such a dramatic chart, we've included it in here for the first time. This shows, we labeled WTI, there are several, when people talk about the price of oil, there's several different types of oil. There's what's known as Brent North Sea crude, there's WTI, which is Texas oil. The difference between the different oils, in short, is how much refining it needs. So, for instance, Brent would go more than light sweet crude because light sweet crude, by the definition, it is easier to refine. There's less impurities in there, so the price would be lower. But nevertheless, the price of oil, you'll see the high just a few years ago at 113. In fact, just within the last few months was over $100 a barrel, and now we're in the 40s. There are geopolitical reasons for this. There are supply-demand reasons for this. There are a combination of reasons why this has happened. But this, in general, the consensus is helps the U.S. consumer, doesn't necessarily help businesses overall, but is certainly a tax cut for individuals. Tax cut, I use that in quotes because it's not actually a tax cut, but you now have people have extra money in their pockets, which will help the U.S. economy going forward. VIX on page 18, which is the volatility index. We'll go through this a little later with the returns, but the last several weeks and months, the volatility has increased. You've seen in the markets moves in the Dow Jones of several hundred points in a single day, in the S&P and other, including Dow Jones of percent or more each day, and that makes the VIX go up. The day we printed this, which was the 27th, so you see it was through the 26th, it was back down to 16, but anytime there's a bad day, it goes back up into the 20s, which was double where it was. You see the low just a few months ago at 10. It was in the low teens before. 40 is considered a high level, and the VIX is a contrary indicator. When volatility is low, it's usually not a bad time to take the profits and sell. And when volatility is high, it usually means the market has gone down, so it's a good time to buy. Historically, that's what. Page 9 is historical yield curves, but I want to turn your attention to the next page, page 20. The 10-year Treasury, the QE program is over, has been over for several months, and yet Treasury prices decline. Why is that? You would expect, in fact, a year ago at this time, the question was, with 10-year rates at 3%, how high will 10-year rates go to? 4%, 4.5%, pick a number. But it was expected to go high, and on the way up, yields have gone down, the prices have gone up. Why? The general reason for this is because in Europe, you're on the either side of a recession. The ECP for them is taking unprecedented moves for their own version of quantitative easing, so they're several years behind us. In the emerging markets, such as China and other emerging markets, the growth rate has slowed from a very high level of growth to a moderate level of growth. Still growth, but low to mid-single digit growth levels when the growth rates were much higher. Of course, the growth rates we expect come from the government, so you have to take that with a grain of salt, but nevertheless, even they are admitting the growth rates are lower. What that means for treasuries is when you have the Spanish equivalent of treasuries, of risk-free bonds that the government issues, Italy, when they're issuing bonds, when their yields are competitive or even in some cases lower than the United States yields, and those governments have issues and deficits and problems and potentially in recession, and their yields are lower than our yields, when an investor sees our currency going up, even if without knowing what the investment is, if you own an investment in a country where the currency is going up, if the investment goes nowhere, but the currency goes up, you make money. So investors see a strong US dollar, and they see that the Treasury, which is a risk-free investment here, compared to other risk-free investments, has a higher yield, they go and they buy Treasuries. When you buy Treasuries, the yield goes down. What does this mean for us with a yield less than 2%? This means when yields do go up, it will be more painful because there will be more room for it to go up. And that's, we'll talk later about why we have the underweight in the core fixed income program. Page 21, we recently updated this chart since this was as of the end of the year. We updated for spreads that just came up for the end of January. I can tell you that high yield spreads in red, which are shown as 483, are now over 500 basis points. And this is versus treasuries. What this means is the market is recognizing, and we'll go through this, what returns were for the sector. The market is recognizing there is risk in these trades in buying high yield bonds, while the companies themselves are okay in general, and while the maturities in general, companies have extended maturities, so there's no large group of companies that are expected to default anytime soon. The marketplace is recognizing that we're not really being paid for the risk. So in high yield, you're paid for risk versus treasury, so it's a relative basis. So the 43 is versus a comparable treasury in maturity. But on an absolute basis, because as you saw on the page before, the yields are so low for treasuries, on an absolute basis, are we paying paid enough? And the marketplace is saying no, we're not. And so while spreads are increasing to reflect the real risk in the marketplace, the overall yields may not have moved because the treasury prices have gone up. Investment grade prices have also gone up, but to a lesser extent than non-investment grade, because investment grade you expect fewer defaults. Next several pages show what the PEs are in the page 22, 23, and 24, and the earnings and the P's on 23 and 24. Page 23 shows the Russell 3000 versus the showing the Russell 2000 alongside the EFA and emerging markets for PE and expected PE going forward. And page 24 breaks down the U.S. into large, medium, and small cap. And what this shows simply is that the P part has gone down, therefore the PE has become more reasonable. Still expensive on a historical basis, but more reasonable because the P has come down. Page 25 is a very interesting chart. We pointed this out in prior months. This shows through January 26th that the U.S. market, which is in white, this is a one-year period, has a return of over 13%. But the developed markets EFA, which is shown in orange, actually has a negative return, and that's not necessarily because the company prices have gone down, which they have, but it's more because the currency has depreciated quite a bit from 130 to the 1 teens. So when the currency goes down 10, 15, 20%, it's not surprising that the index itself would go down 5%, 4.99. Emerging markets has had a modest rate of return because higher expected U.S. interest rates will impact the borrowing costs for emerging markets as well. Which means that the U.S. has been for the past year, the best place to invest in general. So how did December, this book is about December, how did December do? If you turn to page 27 to 28, the first set of numbers in the paragraph on, the first paragraph on page 27, if you look at the left, the 1 month number, Russell 3000 was flat, fiscal year, which is the third column to the left, is still up 5%. Second column of numbers are not quite as good. The EFA developed markets number for the month was down 346, down over 9% for the fiscal year to date, and emerging markets was down 461, which brought the performance for the fiscal year down nearly 8%. The reason for that, as I mentioned, EFA, you have a group of countries that are on either side of recession, as well as a currency that is depreciating. So when we measure it in dollar terms, the returns are very high. Hedge funds were up slightly for the month, and the last set of column of numbers, or group of numbers on page 27 show the investment grade fixed income. The core plus 5 was up 19 basis points. And in the next page, the first number of the Citigroup BB Single B, which is our high yield index, was down 146, about 1.5%, bringing the fiscal year to date return down to 2.4. Bank loans, which are higher in the capital structure than high yield, you would expect to, when the market goes down, to go down less, and that's what happened. And the fiscal year to date went from positive now to negative 7 basis points. Tips were down 113. Convertibles were down nearly 1%. REITs, which you have as a parking place, a partial parking place for real estate, because interest rates went down. REITs are very sensitive to interest rates, so interest rates went down. So the number is a positive of 178. If you look at the fiscal year to date, the return's over 10%, so over 11%. So taken all together, on the next page, on page 29, how did REITs do? Police pension fund on the left, 1 month return was a negative 43 basis points because of the negative returns that you saw in a lot of asset classes. You'll see, pardon me, in yellow, EFA contributed a negative 25 basis points, but in green on top, you'll see that U.S. contributed a positive return. So, as we mentioned before, the negative returns are the returns that hurt, and even on the emerging markets, there was also a 25 negative basis point impact. Overall, 43 basis points. Fiscal year to date, through the first 6 months, was 129. We'll go through our estimate of January in a little bit. Where are we versus policy in December? So, as you know, there was a skim payment in December. So where are we after that? And where are we? I calculated this morning where we are as of yesterday. So we show here, if you look all the way on the left, this is an order of the colors that are in the middle of the page. So we start on the left with domestic equity. We show, as Scott has been saying over the past 6 months or so, we've been taking down the bet which we had it as a maximum in U.S. equity, which probably made sense because that rally was long in the tooth. And we're taking it down to a neutral weight. We're showing it at a 70 basis point overweight. And I can tell you, as of yesterday, the U.S. equity weight was not 70 basis points overweight, but was pretty much even with the benchmark. If we ran this today, it would be a flat line. Same thing with EFA and emerging markets, 60 basis points to 70 basis points underweight. Our aim is to have it roughly in line with the benchmark. Obviously, markets move, so you can have a 20, 30 basis point move in a day, especially when you have volatile markets. The key numbers on this page are on the fixed income side of the page, which is light blue for Core Plus 5 and light purple for TIPS. Core Plus 5, we are underweight by 1.8%. That is by design because you saw the yield on the 10-year Treasury. To earn our 7% with the Core Plus 5, I can tell you right now, the numbers just came out yesterday, the yield to maturity on the Core Plus 5 index as of yesterday was less than 2.5%, 2.4%. So that does not, as Barry will tell you, that is less than what the input was into the asset allocation. And if interest rates go down further, when interest rates rise, you'll have negative returns. So that's why we have the underweight. TIPS, we're slightly beyond the 2% limitation of the rebalancing. So what are we doing? I can tell you as of yesterday, the TIPS allocation was in compliance, was 3.05 versus a 5% policy. So we were in compliance with all the policies. Cash is 3.2%. As Scott has mentioned before, what we've done with cash is really anything up to a 4-year maturity. We think of cash as overnight to pay benefits. But what we've done is when we took the money from the overweight in U.S. equity, we parked it in a couple of other asset classes, including some in Core Plus 5. But because of the risk-return reward where you have a very low potential return and yield in the Core Plus 5 is just over 2%, but you have a duration of over 6.5 years, which means if interest rates go up by 1%, you lose 6.5%. So a yield of 2%, and you could lose a lot of money if yields go up, is a bad trade-off. So what we did, we put the money in the cash bucket. It's not really cash per se. What we did is about half of that, 3.2%, about 1.5% of that is 2-year treasuries and agencies, on-the-run treasuries and agencies. Treasuries are about 50 basis points you earn, and you have very limited duration. So if rates go up, yes, you will lose money, but you'll lose a very small amount. And you are earning better than the roughly zero return on short-term overnight rates. Question came from the mayor's office last month about what this does in the total fixed income program. So I can give you an idea. When you take into account the 1.5%, so the first question was, I believe, how much we have put in, how much of that cash is for the parking that we have instead of the Core Plus 5, and it's approximately half for police. So of the 3%, approximately 1.5 is in Treasury and on-the-run agencies earning about, if it's Treasury, it's about 50 basis points. We bought it when it was about 60 basis points, so we made somewhat of a capital gain because it's back down to about 47 basis points. And agencies which are a little bit above that, 75, 80 basis points. So we're underweight by in the Core Plus 5 by about 1.5%. This shows 1.8. As of yesterday, we were down 1.5%. So the math works out perfectly. We're underweight the policy by 1.5%, and we have 1.5% parked in what we call cash, which is really 2-year treasuries. We did the math, and because of our underweight within the Core Plus 5, we have that on another page, we're underweight treasuries, the treasury sector by about 5%, and we're overweight the spread sectors, mortgage, and mostly investment-grade credit. Investment-grade credit is overweight by 3.5 of that 5%. When you take that into account, the yield, you actually end up with a much better risk-return profile, risk-reward profile. The benchmark duration for the Core Plus 5 is about 6.2 years. By having an underweight to the core plus 5 and putting the money in 2-year treasuries and agencies, while you have a lower return, I'll get to that in a moment. So instead of having a 6.2 year duration, the duration of the core plus 5 is now 5.1 years. So that obviously is a full year lower than the index, which is what we want. Compared to the Barclays Ag duration is 5.37, about 5.4 years, so even below that. What does that do for yield? Because you would expect a lower yield. And in fact, we do have a lower yield, because the cash, when you take into consideration the cash. So if you take the cash plus the core plus 5, the yield is about 2.3%. But still, while the yield of the core plus 5 index is 2.47%, so we have a lower yield, slightly lower yield in the core plus 5, we have a significantly lower duration. And when you compare it against the Barclays aggregate yield is 1.9%. So we actually have a pretty good trade-off. We have a lower yield, we have a lower duration, and we have a higher yield than the Barclays aggregate. And that's what we were trying to do.
Follow-up question for that, actually. What would be, I guess, how much would rates have to rise for the trade-off to be worth it?
Yeah.
I guess is the question. Because if we're talking, 17 basis points less yield, essentially,
Yeah,
from
we're
your guys'
looking
calculation.
to when rates go into threes.
Okay, so you're saying that
When the overall 10-year goes into threes, obviously it depends on the yield curve, because if the yield curve flattens or have kinks in it, but if it is a parallel move in the yield curve and the 10-year is in the threes, that's when we start moving money back.
So would only essentially a parallel shift make it worth? I mean, like what happens if it does flatten and the short end kind of goes up and the long end kind of stays?
Well, that actually wouldn't affect us, because our depending on how short end moves up, the 1 to 5 year treasuries are not in our benchmark.
No, it's I guess but we're parked there right now.
Right, and that's because we want to take less duration risk without affecting the yield too much.
Absolutely. So I guess what I'm saying is that
You're looking for a break even.
Yes, absolutely.
Right.
And
We can come back next month.
okay.
And different scenarios if rates rise by a certain amount,
Yes.
given parallel shifts. Because if you looked at the yield curve and say there's a bull market flattener or the bear market flattener, there's so many different permutations. So we'll take some scenarios if there's a parallel shift.
And just to get kind of a quantification
Right,
of all,
right.
what we're giving up and what we're getting from
Right.
each of them.
So the numbers are what I told you. We're actually getting a slightly lower yield by about less than 20 basis points, but we're getting a full year's less duration, which we feel is a pretty good trade. And we'll come back to you next month on the break-even scenarios. Just jot it down. So that's where we're set up on page 30. We would not expect much to change unless yields go up, and that's probably not going to happen in the next month. And if it does, we'll take action. And that money would simply move back into tips and corporates. Page 31 shows the same thing, but it's raw numbers without the adjustments, which are the parking places. Page 32 through 34 are each individual asset class showing the market values and policies as well as what the adjustments are. So you see U.S. equities policy is 34%, but the adjusted policy is 35.4%. And the next page shows what those adjustments are, where they come from. Those come down over time. For instance, tips. The reason we underwrite tips is tips, as Barry knows, is a parking place for real estate. As we put more money in real estate, that parking place goes away, and so we're no longer as underweight as we were before. I want to give you a hint as to what the January numbers were. I told you what December numbers were. January numbers, and this was mostly from the last couple of days in January, which were quite volatile. The Russell 3000 was down 2.9%. Non-U.S. equity markets were up by about 0.5%, both developed and emerging. REITs were up over 6%. Core plus 5 was up 2.5%, very strong number. TIPS were up over 3%. High yield was up 60 basis points. Bank loans were up 30 basis points, and convertibles were down about 1%. So taking that all together, you remember the chart that showed we were over 1% fiscal year to date because of the negative equity markets. We would expect that would hit police. It depends on obviously what the managers do, but based on just indexes, we're probably just below 1%. The return would probably be a slight negative for the month of January. We'll know that, and we'll have that for you next month. Page 36, 35 and 36 show the market values. 6.9% is the 10-year return. And starting on page 37, going through the rest of the book, except for the last few pages, which show private equity and real estate and all the holdings there. Starting on page 37, we show the asset classes, as well as the returns, as well as each individual manager versus their benchmark. So unless there are other questions, that's what I had for the public session.
Okay. So we need a
Make a motion that we leave the public session and go into executive session.
Second? Second. Okay, thank you.